All right, guys. I hope you can see the screen. So if I go back
Yes.
to the intro, the last week we started with F3, and we are discussing about the financial objectives. What are the financial objectives? So basically, it includes types of companies, what they do, and everything. And second chapter, we are discussing about non-financial objectives. That was more about the integrated reporting and why non-financial reporting is important and stuff like that. Okay. So we'll start the discussion of doubts. Mega, you can start. What's your question?
Actually, I want to know that what are the means difference between the listed company and unlisted company, because what are the rights means listed company has and unlisted company does not.
Right.
I asked they can't uh, they can't apply for bonds in the market. They can't raise finance through bonds in the market.
Okay. So basically, first point to that, we'll have a detailed discussion about this listed and unlisted in the coming chapters. We have not covered that, Mega. Okay.
Okay.
However, I can give you an basic overview. So being listed and being unlisted has number of advantages and disadvantages. For example, you talk about finance. So both of them can raise finance. They can raise finance through equity also, debt also. Obviously, being a listed, sometimes we use the word floated company, right? So floated company or listed company will have more sources of finance to raise. In fact, they have better goodwill in the market. And what is the primary advantage of getting listed, to be honest? What is that? It's to raise money, it's to raise more money, right? The
Yeah.
disadvantage is you'll have more and more paperwork and more scrutiny from the government. Why there is more scrutiny from the government? Because now you are not raising money from the private shareholders, but the normal public, the citizens. So what happens? It's government responsibility to safeguard their interest. And a normal person doesn't understand about the finance and how things will work. They can easily get cheated. So government have their bodies, like we have in India, we have SEBI, Security Exchange Board of board in India. Then we have different body, I think FTA in UK and something in the US. So like this, we have different bodies in different countries who regulate this market. So all of this will have advantage, disadvantage. But if you look at the advantage of being unlisted, you don't have lot of paperwork, lot of scrutiny. You don't need to have mandatory following of the corporate governance or internal audit. You're kind of free, right? The business is quite free. They don't need to make their financials public. So mostly when company grows, they want to go from unlisted to listed company. In fact, that is one of the exit route. If you see the entire business model, how business works, firstly, any business that is successful, or most of them, they start like in startup, maybe one, two, three people from an idea, then slowly it grows. If you see in the market on average, they are taking 12 to 15 years before they go for listing. So till 12 to 15 years, it's a private limited company. Then they go and become a public company. So usually when they grow, they want to have a proper structure, they want to have a proper board, and a lot of time the startup founder want to realize the profit. Well, that's the time they can earn. Then they can bring in other expertise also. That's where they go for listing. However, in certain cases, some companies might become from listed to unlisted because they are not happy with the scrutiny, with the paperwork. Or some cases, a listed company can become a government company also. Government can acquire it. For example, if you see Tata's in India, they were private first, then the government acquired, now they are private again. Okay,
Yeah.
makes sense.
So from exam point of view, what are the things we needs to understand um while giving any suggestion, like whether a company should be a listed one or not? Means
Right. So basically, our company, 99% of the scenario in CIMA exam is listed because it's quite big. And once it is listed, they can test you on so many things. Okay. And another
okay,
question is, when it comes to acquisition, most of the time it will be unlisted, or sometime it can be listed also. So which one is good for us? So this is a case study exam. So in case study exam, we cannot say anything now. It will depend on number of scenarios
okay,
on that situation. But
okay,
mostly companies find it easier to acquire unlisted companies because the best reason is cheaper compared to listed company.
okay,
But again, many companies can go to acquire listed companies as well. So it all depends on the situation and what is your objective of doing that. If we don't know
okay,
the scenario, we cannot commit which one it is. In the real world, I mean, this question uh, is very good and helpful for all of us for discussion. What's the difference between scenario and other, other exams, case study based and other exams? So case study based all depends on scenario. Maybe in a normal situation, that step may be wrong, but when it comes to case study, when you know the exact scenario, the situation, that will become the best step to take forward.
okay. Yeah, thank you.
No problem. Any other question?
No,
No, no, it's clear. I gone through today's two upcoming chapter as well to just fresh up again.
Very good, Divesh. Thank you for that. So basically, we are starting with chapter 3 today. Just give me a second. Hello, Sophia. You okay?
Hi, I mean, thank you. I'm okay, thank you.
Oh, you're welcome. So we are just starting the session. We have
Sure.
not missed anything. So, guys, we'll be starting with development of financial strategy today. I hope you can see the screen. Basically, F3, F3 itself is a financial strategy, and every exam will have this question: financial strategy. So, very important. This is rather an introductory to the other sections. So, first we'll start with some of the basic things. Then we'll go to specific scenario. However, if you see, a lot of things might overlaps when we do E3 and P3 also. Okay. So first is strategy. Okay. Understanding of the strategy and all. They have given a quite basic intro also. I like to know from you. I'll come on that. Development of financial strategy. So just like anything, we need a strategy for finance. Obviously, finance is the backbone of any organization. Like we have marketing strategy, we need to have IT strategy, cyber security strategy, we need to have human resource strategy. But the most important of all is what? Financial strategy. If you guys have work in budgeting, right? How budgeting starts? Most of the budgeting things will start with the available resources, right? If you know the resources, if you know how much money we have, then you'll plan the strategy. For example, the marketing budget, let's say for companies like Apple or companies like Oppo, you know, definitely Apple will have very high budget for their marketing. So even they want to have any other budgeting for certain things when they are correct, selecting a supplier. So that time their budget will be different. So all of this will make a lot of difference. So everything basically start with the budget, right? And for that budget, we need to have a financial strategy, because every budget and every cost you're allocating to certain things, that will match to the financial strategy you are selecting for the organization. What is your working capital? How much we are committing to the fixed expenses and variable expenses. What are fixed expenses? The basics. Fixed expenses is like which you have to do every month or every quarter, every year, irrespective of the revenue or irrespective of your sales. Or if it is a manufacturing company, irrespective of the manufacturing you're doing. But the variable, it will be according to the inventory, according to the sales, and a lot of other factors. And also we have some things which are mixed. It may be fixed up to a certain extent, then it will become variable. For example, sometimes electricity can act as fixed, but if you cross certain numbers, it can become variable. Same thing goes in the other sector. So for that, we need a strategy. In fact, your exam itself is called a strategy. And the most beautiful part is you don't need to have a fixed strategy. Imagine if you have a fixed strategy, we don't need to discuss all of this. You guys are working, so a lot of you will understand that in real world, the life is not so simple. This is right, this is wrong. Sometimes both situation might look right, and you have to select what is more right. And sometimes both situation will look wrong. You have to select which is less wrong, right? So for a similar situation, all of us can tend to take different decisions based on our understanding, based on our risk appetite, based on our knowledge, based on our experience. Therefore, CIMA also tells that for a single question, you can have hundreds of correct answers. I'm telling hundreds, as long as you are making business sense, as long as it is logical, then we can have number of answers. In fact, one of the reason why students might not get good grades, they try to rote write. They try to just by heart thing and repeat it. So we'll not do that. Therefore, I motivate all of you to just say what you think. Right? You don't need to copy what is there in the suggested answer or what somebody else is saying in the class. What you feel like, you can just answer. The only thing that matters, you might have to, and it's good in fact to justify your answer. Why you feel in a certain way. For example, if you're talking about financial strategy, then let's say we are talking about debt versus equity, the most relevant topic, right? Mostly tested. So for the same question, some of you will say debt, some of you will say equity. Maybe some of you can even recommend don't use debt and equity. Maybe go for a government grant or use our retained earnings. So all of this will make sense as long as you justify and as long as it is relevant to the scenario. All right. So the basic terms strategy. So according to CIMA text, again, if you go in different textbook, you'll find a different definition. You are not allowed. I'm not saying allowed. I'm saying it's not required to learn a lot of things. It's just about understanding. When I say learn, you don't need to buy hard it. Okay. Strategy: a course of action, including the specification of resources required to achieve a specific objective. So very important. If you see a strategy, even now we are preparing for the exam, we need a strategy. So ultimately, three things matter. So what are those? First is a plan. What is a plan? Or we can say a course of action. Second is including the specification of resources. And third is to achieve a specific objective. So basically, in strategy, three things matter. One is the plan, one is the resources, and one is your end goal, where you want to go. Imagine if you don't know where you want to reach. For example, a company is in point A, now their strategy is, let's say, to increase the revenue by 10% next year. So that is the point B. If you don't know where is the point B, you cannot achieve, right? But at the same time, we should have a clear plan what you will do to reach from point A to point B, from, let's say, 1 million revenue to 1.1 million revenue. That is a 10% increase. Then another aspect, the most important, uh, uh, yes, Vishal.
So hi everyone. Misbah, so when I talk about strategy, does it always necessarily needs to have a financial strategy, or it can have a non-financial strategy into this embedded?
So, if I give you one word answer, no, you don't need to have financial strategy for everything.
Hmm.
However, a lot of things are motivated by the financial strategy, because if you see, everything will come down to budget, especially when you are doing things internally.
Correct. And as we were discussing in the last conversation, any non-financial elements have an indirect impact on the financial implications or probably outcomes, right? So when we devise a strategy, not necessarily we have to think only from a financial objective perspective, or do we nearly need to look at from that point of view whether everything will make sense from a finance standpoint, not necessarily yielding outcome in next 1 or 2 years. The strategy could be more overarching for more than 5 years or something, right?
Yes. So, when you that's a very good question. First, most of the time we are planning for the future, right? Future, obviously, strategies for future, but long term future, and we don't know what happens. So there will be a lot of uncertainties and risk ahead of us. So
Yeah.
definitely we start with this, and at the same time we need to be a little bit flexible with the financial strategy, because many
Okay.
times what happens due to unforeseen circumstances or external situation, you have to forcefully increase the budget.
Hmm.
So companies need to flexible. So everything cannot be from finance point of view, and some of the things are not compromisable. For example, it comes to quality. After COVID, if you would have noticed, for all of us, that the inflation was going up, even in the countries where usually the inflation is stable, it went up to double digit. So that time companies have to increase their budget, have to increase their spending. There is no other option. In fact, most of the time, companies will not be spending according to their budget. Many times they'll go over that.
Yeah.
However, it's good to have something which is a starting point.
Yeah.
Therefore,
Yeah.
in E3 also we'll be discussing the type of strategy. So we have a strategy called that is emergent. We'll come to that. So emergent is saying be flexible. If you see it's not working, just switch. There is another one which is rational, that is rigid. That says no, just be strict to that. So definitely rigid will struggle sometimes, because they don't want to spend more money. They don't want to disturb their financial strategy. However, if you are changing other strategy, definitely this will also get affected. For example, if I link this to a project, so what are the three main areas of project? We have time, we have the cost, and we have the quality. So any one of those factor get changed, it's like a triangle, others two will get affected. For example, if it's taking more time, then it will require more cost. And if we are trying to improve the quality, again it will take more time and cost. I hope it makes sense.
Yeah. Clear. Thank you.
You're welcome. So the course of action we are discussing, the plan is very, very important, because again, if you are going from A to B, you need to know how you are going, because again, some companies will have a risky approach and some will have less risky approach. For example, the same one, you want to increase the revenue by 10%. So one company will say, okay, I'll spend uh, more money in marketing. Another company will say, okay, I'll acquire another company to increase my sales. Some might say, I don't want to increase in marketing, I don't want to acquire anything, I'll just improve the efficiency of my employees. Maybe they are uh, not utilizing up to their level. Or some might say, okay, I don't care about revenue, I'll just focus on cost cutting, and ultimately you want to increase the profit. So I can still do with the same numbers. So that is a course of action. And the most important is the resources. What resources we have? Companies like Google will have so much of resources when you compare to small ed tech startup, or any startup companies. If you see startup, the biggest problem is the resource. They have a very good course of action. They have very high risk taking capacity. They have their objectives, but they might struggle in resources. They might have to compromise on the resources. In fact, if we just see the entire CIMA exams, it is this sentence, this statement. We can discuss about this for hours and hours. Even if you see for your exams now, what is our objective? To get a CGMA membership, right? So we have made a course of action, how we'll study and everything. Then we are utilizing the resources. What are the resources? These materials are the resources. The tuition class is the resources. If you're doing something online research, that's the resources. Same thing happens in our personal life. Your career, your objective is, let's say, to become a CFO. So what is your plan? How many years? What is the course of action? Let's say you want to be there in 5 years, 7 years down the line. Okay, so how I can break it in yearly target? How much it can be on quarterly? Then ultimately the resources. So for example, in that, what can be the resources you are using? Okay, I'm utilizing, I have some saving, I'll make sure that I invest some money, or let's say the earnings, whatever I'm earning, I'll invest 10%, 20% into my learning. You might have read somewhere, I'm sure, if you see a lot of the top people, they have a rule. They want to invest at least 10% of their earnings into the learning, because if you learn more, you learn more. However, if you see the normal people, they don't study a lot. They will just do their work. They don't upgrade themselves much. But anybody who is at the top position for a big company, they have to keep on upgrading. So they have made some uh, numbers. They have made their own personal financial commitment, because that's the resources which will help them to achieve the objectives. More or less, this sentence, if we understood this definition, we have understood the entire thing what we're studying in E3, P3, F3. What is the pre-scene? Because this thing goes on and on. For example, now again, if you go out of F pillar, right, financial strategy, if I come to E3, E3 is about how to select a strategy. What are the things that will motivate us to select that? Sometimes it is internally, the companies plan to do a certain way, and certain time it is an external pressure. You have to forcefully do it. So what can be an external pressure? External pressure can be, let's say, COVID. What happened in COVID? It was forceful for the company to cut down on the expenses, to move online, right? Or sometimes it's internal, that a new CEO has come and they want to work in a different way. Or maybe it can be mix, or it can be a disruption in the market. What is disruption? When a new company has come and they have changed the entire way of doing business. Like we have fintechs coming up. So definitely fintech is a big challenge for the traditional bank. They are surviving now because of the government support. Otherwise, nobody wants to give so much commission to the banks. They charge very high, right? Both the sides. Same thing if you see in the education. We have the top universities of the world like Harvard, Yale, and so many of them, those who are providing online courses, online degrees. Bachelor's is there, master's is there, graduate, undergraduate, what we call it. So the only problem is the government is saying we'll give more value when it is done in a physical situation, when it's done in person. Otherwise, nobody will want to go to this average colleges or universities. So a lot of things will come in place when we are doing it. Okay, does it make sense?
Yes.
Thank you. So I like to know from each one of you one example of a strategy. It can be financial strategy, it can be any strategy. Just give me an example that, okay, for this company, or you can give for a person, this is the objective, this was the course of action, and this is the resource they have utilized. You don't need to give a real world, you can just give a fictional example as well. You just want to understand that you have got this meaning of strategy. I'll start with a very basic example. Let's say there is a company in FMCG. They are holding, let's say, 20% of the market share. Now their objective was to become a market leader. And in order to become market leader, let's say they need another 5% of the market share. Right? So the resources they have were, they're a listed company, they have good finance. It was easy for them to, raise money. Uh, 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 their books were showing good, they have good gearing and everything. So company say, okay, I will raise the money through debt and I'll acquire another company with 5% market share. Will achieve my objective. That's it. So course of action was acquisition. Resources required was finance through debt, which we have. An objective was to achieve another 5% of the market share. So that's done. That was the strategy.
Can I give also an example?
Yeah, please, Sophia. Go ahead.
Well, again, in the food industry, which I think it's kind of easier. So you have like a distributor of fresh produce that he's located in a country that they're not producing a lot due to climate position, so they need to import a lot. So they have a strategy because they are very vulnerable to their suppliers, unfortunately, due to the specific circumstances of doing business in this specific area. They have a strategy of doing a vertical backward integration, basically going into other countries and buying properties so they become the supplier as well. So the financial aspect of the strategy is basically make sure you raise the finance to be able to do this kind of strategy, at the same time work a human capital strategy to make sure that you work in a different environment to the previous that you know, a more international one. And another strategy on the logistics, because now you have to have your own supply chain set up.
Very good, Sophia. That,
Thank
that
you.
that is a very good example. So you have given a number of steps, number of course of action to do that, like a backward integration, then the human resource, all of this. Good, makes sense.
Thank you.
I request all of you to just give one of them, one example. You can just try. We are learning here. Nobody's judging you. If you want, you can think for a minute and answer.
Uh, I'll give a different answer. I'll talk about myself. I'm working towards getting a sponsorship, so I am strategizing, like upskilling myself through CIMA, so that I could achieve that goal of mine to get a sponsorship. And the best way is to get more experience and upskilling yourself. So does it make sense?
Yes. And what are the resources you are using? You have told about the objectives, the course.
SEMA is the thing which I'm using. The resources is like the case studies which I'm going through, the upskilling basically of mine will help me to achieve that goal of getting a sponsorship. What I believe. Am I working on my resume? Am I broaden myself, like my knowledge? That
Okay.
gonna help. Yeah. And on the, like, if I talk about a business, if a business is doing well at a GM level, but they got to know that during their operating margin or EBITDA level, they are getting a hit. So what they could strategize to think more about the salaries which are getting paid to the high level employees or the admin staff, or which are not directly related to the um, generation of the revenue. They can give a deep dive into it, and they can see if there are certain expenses which they can control or not, in order to get their net profit corrected or get in line with the GM which is increasing. Does it make sense from the business point?
Yes, it does. Yeah. Okay. Next, please. Yeah, yeah, Mr. Vishal. Go ahead.
So we are doing it. This is a real time example. So we are working on capital and cash flow. Now, given this the need for developing and probably increasing the cash flow, so we are trying to look at our, and this is I'm looking at from a supplier standpoint and looking at the purchase cycle. So we have conscious efforts of making our DPO work, and for that, what we are doing is that we have started looking at holding cash as a strategy. And in order to achieve that, what we are re-looking at are top suppliers who we can renegotiate and recontract in terms of the payment cycle to ensure that the bigger ones are negotiated with a better payment terms for us, which would mean that I'm looking at my increased cash flow for any working capital requirement.
Nice. Makes sense. Next, please. Fahim, you want to try?
Yeah, the Dubai government want to make the paperless government for 2030 or 2035. They have a target. For achieve this one, they're using for the online payment and through the application payment and all the departments for all the ministries, they're accepting the payment through developing the online such as things. They can achieve it. Hope the resources, then they can achieve the goals for the paperless government by 2030.
Okay. And what are the resources the government need to achieve
The
that?
resources, the developing the online payment method and through the applications, through app development. For example, if they want to pay any police fine or they want to pay visa fees, they develop their own application. They can pay through the electronics payments. They have to make it easier.
Right. So basically, they need a digital infrastructure.
Digital infrastructure, we can say.
Good.
Okay.
Megha, Taran, Divesh.
So I would give example of my current company, like the where I am working. We basically working in the construct like working on project basis. So what our proposal managers do to get in the projects in a business, so they have strategized like they contact the oil as like oil rig companies, oil rig companies and all, and they try to bid project as less as so they can get more project and like the business money floating regularly, so we won't get much working capital issues as well, and company can survive long last. So this is what they strategize. So they first try to get as much as project and proposal and try to beat lowest one so they can get under the profit margin about 30 to 40 percentage, and they can still get more project and try to expand their business. So this is how they are doing it. Another example for myself, like as I
One
am
second.
trying,
So the
sorry.
previous one, what resources your company is using to get a good pricing?
They
What
are
resources?
building a good relationship with the clients,
Very
like
good.
the big oil rig companies or offshore energy producing companies to get contracts. So they build a very good relationship with them to achieve a valuable project to survive our own company as well and make sure that we are making a profit instead of a loss. So this is one example, and another is if I am putting myself as I am trying to pursue CIMA MA to clear my exam, I am investing my time as a resourcing, making sure that all the concepts what I have been learning I can remember and understand properly to to clear my exam and make it my career more better and get a good job. This is how I'm strategizing myself to clear a CIMA and get a good career ahead. This is would be a strategy as well.
Yeah, makes sense. Mega.
If some business means company is good in their business and they want to grow upstream or downstream, means if they are producing, for example, in real estate, if builder they are constructing the building, and if they want to grow in upstream, means how to they can grow in upstream, producing their own raw materials.
Okay.
So yeah, and that can be used in the construction. So for that growth they need finance, so they have to build a financial strategy, and for that they can analyze the different source of finance, and according to that they can grow upstream or downstream, to uh, expand their business. If they are
Okay.
good in real estate and they want to grow in another, then upstream and downstream growth also can be, they can opt, and for that they need financial strategy.
Okay. So resource you are saying is finance. So here, what you're talking, we can take an example of a company called Adani. So Adani in India, they are into real estate, but they have started their own cement manufacturing also. That was
Like paint, yeah, and manufacturing paint.
the paint also they are doing. That's also forward integration. Yeah, makes sense. The resources you are saying finance, and they are doing most of this through acquisition. Okay,
Yeah.
very good. This Taran, are you able to talk? Or you have issue with your mic still? You can put in chat if you have problem. All right, so good one, guys. So same thing you have to remember when you're writing your exams. We'll be discussing this point again and again from different perspective. And once we have our pre-scene in few weeks, things will become more interesting. So moving forward, financial strategy. So what it is the aspect of strategy which falls within the scope of financial management, which will include decision on investment, financing, and dividends. So we have kind of discussed this. However, there are three important areas when you're talking about financial strategy. Why three important? Because all three of these are interlinked. What is that? First is investment, second is financing, third one is dividend. So investment. For example, now you want to invest. Let's say we want to invest to acquire a company. The last example what Mega was doing, let's say a paint company or anything. So when you want to do investment in that, what we need the finance, because most of the time companies will not have enough retained earnings to do such a big investment. What they have to do, they have to raise money through debt, equity, or any other source what they have, right? So the amount of investment we have to raise will depend upon the strategy, and the amount of investment we can raise depending upon our financing capacity. Then the third one is dividend. So why we might not have a lot of retained earnings? Because we are paying out dividends. Because being a listed company or even unlisted company, they have to give out dividends. What is dividends? Dividends is nothing but share of profits. And who do you share the profit with? The owners of the business. So if let's say a company is giving 90% of the dividends, they'll end up with only 10% of the profits in the retained earnings. So with 10% of money, we cannot finance lot of project. We cannot do lot of investment. If you need high investment, you need to save money from the dividends. You need to have good relationship with the banks and other finance providers, financial institutions. So more or less the thing is, all of these three are interconnected. You cannot take a decision in isolation. A company cannot say, oh, okay, I'll give you 100% of the dividend. I want to keep my shareholders happy. But if you do that, this will be a very short term. What you will do next year when you need money? You might not have the financing option available, or even if you have, it might not be on a suitable rate. The interest rates are high, right? So same thing goes when we are talking about a strategy. Let's say in exam you got a question on financing, either to go with debt or equity. So you cannot just answer that thing talking about debt or equity. You might have to link at least a part of your answer about the investment, right? How will be investing the projects, maybe the current one and the future one, and what you have done in the past. Then ultimately you have to be very thoughtful of your dividend. And dividend policy is basically a signal to the shareholders, the future shareholders. For example, in the last pre-scene, the August exam, our company was giving around 90% of the profit in dividends. And in one of the scenario, the question was, company wants to make it to zero and invest that into the project. So technically, the board of directors, they have the right, they have the power, they can do it. But do you think it's easier while they are reducing the dividend to use that money for financing and investment, right? But when you're reducing from 90% to zero, that will give a very bad thing into the market. Maybe we are doing it because we have got a very profitable project, but ultimately the signals, the human emotions, the market will decide what should be the share price. It's not always on the logic. It's about the market sentiments. Therefore you'll see a lot of share price fluctuation keeps on happening, right?
So for like financing aspect, it may be combination of equity and retail earning. We can suggest like that also.
Yes, Megha, you can suggest that, or you can make mix of three. You'll do rights issue from the shareholders, from the current shareholders. You'll use little bit of retained earnings, and you can use little bit of debt. So that depends on company. Nobody is coming. It's not any government body or a government association is coming up and saying that you have to do this in certain way. That is uh, under the control of the organization. Okay, so all of these three things now we'll discuss in detail in the coming chapters. But very important to know that things are interlinked. So when you're answering, you have to be thoughtful. Remember, when we are making a strategy, we have to have an integrate approach. We need to have an holistic view on everything. When somebody is working now, how CIMA looks at an organization. Basically, even in the real world, CIMA is so practical. We usually divide into three levels. What are they? First is the lower level, we call it operational level, where things are happening on the ground, where they're deciding on the marketing, on the stores, and if you're customer facing, if you're B2C, business to consumer, the design and all of those. Then we have the mid level, where we call it a finance manager, where they're doing reporting, where they're deciding where we have to locate the stores, all of those. Then we have the top level, that is called strategic level. So we are doing a role of a strategic level. So at strategic level, or we can say at the top level, we need to understand what's happening at the mid level, what's happening at the bottom level. However, the employees working at the bottom level might not understand what's happening at the top level. That's fine. But we need to understand what's happening in the operational, what's happening in the middle level, and what's happening at the strategic level. And it's not alone about finance. When you're at the top, you can't just think about the finance, you have to think about other aspect also. Therefore, being a finance professional, we are talking more about the cyber security, we are more talking more about risk, we are talking about other aspect also. Maybe that's not the core field of finance, but when you're sitting at the top, you need to have at least some idea about the other aspect as well. And same thing goes with other board of directors. You might have seen a lot of people who are coming from, engineering background, medical background, depending on the industry they are working. They also have some basic idea about finance, or companies motivate them, train them on basic financial education. At least they should be able to read and analyze the financial statements. They should know what is the financial position, what is income statement, and what does it tell. Okay. Then strategic financial management, what they're saying, the identification of the possible strategies capable of maximizing an entity's NPV. What is NPV? Net present value. So this is basically a calculation we do to, it's a starting point to understand how much return we'll get from a certain project. The allocation of scarce capital resources among competing opportunities, and the implementation and monitoring of chosen strategies so as to achieve stated objectives. So basically, more or less same strategy we are talking about, but little bit we are mixing into financial management and all. You can just have a basic understanding of the top. That was easier for you to remember. Now, if you go little bit into each of them, if you start with investing, firstly, can you tell me, your understanding why companies need to invest? Usually, when you're talking about a company, they are actually earning profits, right? Because if they don't earn profits for a while, they have to stop doing business, right? Because we are working for a for profit business. So if a company is still doing good, why do you think companies need to invest in the first position? Why they have to take this risk? Because if we invest, obviously we might achieve our goal or we might not achieve. In fact, most of the time companies won't achieve. So why do you think any company should invest at the first place?
To grow.
Okay. Why you need to grow, Sophia?
Well, actually, that's a little bit tricky because it's not necessarily to grow. Some companies might want to grow further, or somebody has to invest because they need to increase their market share. Others, they need to invest in other products. Kind of depends on the type of the business you are in. But you still need to invest in infrastructure, in your people, like going in investment strategy of acquiring other business. I mean, if you don't have an investment mindset, eventually you will be relevant in your
Well,
industry at some point. Even sometime, even to maintain your share, you might need to invest.
good point. I like it, especially the last part. Not
Yeah,
everybody wants to grow, especially companies who are at mid level. They don't want to grow, or family business, they don't want to grow much, because when they grow, the government regulations will increase, so they are okay. However, they need to invest because they need to sustain, they need to be relevant, because we are living in the environment which is constantly changing. Especially now, the world is so much globalized. You can outsource almost everything, any part of the world, right? Even if you see now our classes, we are, maybe coming from 6 7 different countries, 3 4 continents. So things have changed. We have to be relevant, we have to be sustaining to the disruptions. Even if we don't do anything, companies like Amazon, Google, we have Tesla, these are so much of risk taking. If they come to our industry, they might just throw us out of business. Maybe last year we have been making a lot of money, we are one of the top companies, but maybe this year we are completely out, we are zeroed down. That can happen. So definitely we have to be proactive and do the investment. Good point. Yeah. Others, what's your view? Why you think a company should invest?
uh, company have to invest because they want to increase the shareholders the wealth, the dividends to be high. And also, if you not invest, keep the money in the bank or some other place, the inflation rate, if you compare, the inflation rate is high. Then if you keep it 1 year, some certain of money, it will be go. It will be. I mean, it wipe off your money value. Considering the money value, better to invest some other place, in return take the good return and pay the dividends to the shareholders.
Good point. So ultimately, it's our ethical responsibility to earn the profit. And obviously, shareholders are giving their money for us to earn profits and return them back. So if we invest in more projects or keep on doing good, we can give them higher profits. If we don't, then they'll start taking money out of the business and they'll invest in some other company. Taran has one answer on the text. Diversification into different market niche strategies could focus on expanding into related sectors or customer segments. By doing this way, the company reduce risk, and in the way, company can get into new revenue streams which could lead a long-term stability and growth. Good point. So basically, in the chapter 2 last Sunday when we start first class, we are discussing about sustainability. So sustainability is often thought of just in the environmental aspect. How it's not only about the environmental aspect, even the financial aspect. We need sustainability. We need sustainability of the business. We'll even discuss this in detail when we'll start our P3 risk management. A lot of companies they want to diversify, especially they want to have one part of the business into the industry which is even sustainable during recession, because now the the global situation, the geopolitical situation is very tricky. Something happened in Sri Lanka some around 2 years back, then we are seeing something in Bangladesh happening now. So what is happening in Bangladesh has affected the entire clothing industry, because they were the one, they were the best manufacturers, they have the lot of control on the supply chain, right? Let's say our business is into that. So things like that matter. And now we have to be even more careful. We don't know what the new situation might come up. So companies want to invest in the industry which is kind of recession free. Maybe they can go into education, they want to go into healthcare, they can go in some other sector where they feel the risk involved is low. Because even if it's a recession, even if people have very less money to spend, they need healthcare, they need education, they need food to survive, right? So that is also one way of sustainability. Good point, Taran. Yeah. Others also, please give your point quickly.
Uh, if we are talking about investment, I would say a company which is into manufacturing has reached saturation with their current set of equipments and machinery. They would like to invest in such a machine which will cause less normal loss, as in the manufacturing process there is like certain certain percentage of loss which is meant to be there, you can't avoid it. So they would like to invest in certain machinery that would help them to reduce that normal loss and the other cost, like investing in a more efficient machinery. And they could also invest there in their people by training them in a better way so that they could work efficiently. So this is my point, because all the investment points were covered by the rest of the classmates.
Why you need efficiency, Manmeet?
To capture the market more quickly, I would say, because I would able to generate more products at a better pace as compared to last time. So my overall cost is also a business which is running on economics of scale can can with the help of efficient machinery could produce better product at a cheaper rate, and it will help to capture the market in a better way, because the overall cost might get reduced and they could now go to a larger audience as compared to the earlier machinery which could do uh, not that efficient production.
Okay, right. So here we can take an example of China. China has done so much of investment in the infrastructure and training.
Yep.
It's a misconception that companies goes to China because it's cheap, but that's not the main reason. Main reason is the skill of the employees, the efficiency they are putting into the work.
Hmm.
So that thing is required, and that investment is required to improve the effectiveness, the ultimate result of that work. And they might get a lot of outsourcing job, ultimately growing their revenue and profit, especially when you are into B2B business. I mean, in every business we need efficiency, but in B2B, when companies are investing, it's usually a big client, so they'll definitely see what efficiency you are putting into that, how you are upgrading the training. Even if you have good relation there, it might be difficult because the other company might have pressure from their shareholders, so they might have to switch. There might be small changes again, depending upon who is your client. Anybody else wants to add?
Like a company needs to invest in R&D. Sometime like in technology, we see there is lots of changes in the technology. So companies needs to invest in R&D to sustain in the industry, so they can cope up with the competition in the industry. So they have to invest in R&D also.
Right, right. Very good point. I mean, it's almost impossible for certain industries to survive without investing in research and development. Let's say automobile, we have maybe in technology, in all other areas as well. We
Like
need to
for example, in this case, which already I have given, that Nokia and Samsung, if you consider that Nokia has not invested in their R&D in the technology, so they have not come with the new features of the mobile, but Samsung company has invested in that, and they are still in the market with their product, with uh, new features of their product.
right, right. You're correct. So they have to do it. If I tell you one fact, maybe it will be helpful. When companies are growing, if you see like a well-established company like Google, their parent company Alphabet. So how these companies work? If you see, even in other industries, they don't have lot of new technologies coming on their own. Maybe they are busy in just handling their such a big empire. So what they do, they are acquiring the startups, because startups are actually taking a lot of risk. They are more innovative. So if you see, these companies keep on acquiring hundreds and hundreds of companies every year. So one of the primary reason is they are getting new technology. They are getting innovative products to add on to them. We don't know a lot of things in publicly. If you research about business news in detail, you might get an idea about it, or maybe still you'll know. A lot of things are happening in confidential, and even some startups have the mindset they want to grow and sell off to their bigger competitor. Another reason can be just to avoid the future competition. Therefore also companies are buying them off. So that's also an investment from the company's point of view. In fact, in the last CIMA exam, we have a question. We want to acquire a business. Actually, we have a data breach. Basically, we have a cyber attack and we have a data breach. Now companies like, we are not doing good, we are not effective, we have a team but still they are not effective. What to do? Shall we train them? So ultimately the board has an proposal, and it was like to acquire a startup, well established startup, I will say. From a while they are working, they have started getting good revenue, and they have got very good into the thing. They are one of the kind of disruptor in the industry. So what to do about that? So the board ultimately decided, let's acquire them. We cannot build that strategy. Companies have certain things. First we'll try to build it in house. If not, then we'll try to acquire from outside. Or maybe that company is not ready to sell, then you have to do partnering. But you do whatever, but get the technology with you, because sometime if you don't have it, then you go out of business. Even if you see now, if you're doing Google search, so you'll get an AI overview, artificial intelligence overview, which you are not getting, I think, few months back, right? So that's also done through certain kind of investment from the company. Because if they don't do that, maybe we'll stop going to Google searches now. And if you don't go to Google searches, they are just making money because of marketing. Then 90% of the revenue is just coming from the marketing. All right. Then we have financing. How should the necessary funds be raised? We'll discuss in then dividends. How much cash should be allocated each year to paid return as a shareholder? Anyways, if we discuss a little bit again in investing, so finance managers are responsible. So basically, when they use the word finance managers, they use the word management, they use the word the board. More or less, they're referring to the same. The people who are involved in running of the business, who are sitting at the top. You don't need to worry because these words are used loosely in the textbook. So finance managers are responsible for allocating financial resources to achieve organizational goals. Right? And to achieve organizational goals, what we need? We need steps. We need the plan. Then we need to know the resources. A key part of her job is understanding the short, medium, and long-term capital needs required to invest in fixed asset and working capital that fit her overall strategy. So we're just discussing about holistic approach, integrated view. Why? Because even if you're investing this year, it's not like that's the last investment. You might need and you will need some more money next year. So where you'll get it? So we need to be very careful. And companies usually divide their short-term goal. Short-term is usually referred to less than a year, then mid-term around 2 to 3 years, then long-term more than 3 years, let's say 4 years, 5 years, 7 years. So we need to have all of these goals in place, and we need to know how much money we'll need for that, investment we'll need for that, and where it will be coming from. Sometimes what happen if a company has a short-term view, so they might get a good deal for, let's say, a good deal on debt. Okay, they have got a better interest rate, but maybe you have signed a covenant with the bank. What is covenant? It's like a promissory note. You have promised them. You have gone into a contract that if I raise, let's say, another debt, then you can charge me higher. Then I'll be taking loan only from you. Something like that. So this will affect the future investments. So we need to be very thoughtful. Therefore, you will see usually people sitting at the top, they are quite visionary. They'll have a long-term plan. And that is very much required. Otherwise, in short term, we might succeed, but in the mid-term and long-term, we'll struggle. I mean, it's very difficult to have a strategy for the long term because the industries are becoming so dynamic. It's always good to have some kind of planning. We might have to be very flexible with that, but at least we should have something. There is one saying, I'm just going a little bit off topic, but at a personal level also I believe in on that. The saying goes like, a fool with a plan can defeat a genius without a plan. So even if that person is dumb and has a plan, can definitely defeat the person who might be a very genius but doesn't have any plan. And same thing goes with everyone, at a business, at a personal level, everywhere. So we need to have plan. Definitely you will not get it exactly, but at least it will help in risk management. It will help in getting better results. Okay. So a potential investment is likely to affect. So what are the areas it will affect? The liquidity of the company. So what is liquidity? Basically, liquidity is linked to the cash flow. And what is cash flow and why we need cash flow? To keep our business running. We'll have certain, again, fixed and variable expenses as we just discussed. Sometimes what happen, companies might take an extra risk to raise finance. That's a very tricky situation. They might go out of the box to do a very big investment, and they have undermined or they have not taken care of their current commitment or the liquidity of the company. So they will struggle in the cash. And there has been certain instances where they have taken so much of risk where the new project failed, and at the same time the current established business doesn't have the funds, they doesn't have the liquidity, they don't have the cash flow, and the current established business also collapsed, and obviously the new project where they have taken very high risk, that was also a failure. So we need to be very careful that what amount of risk the company is taking. We cannot disturb or disrupt the current business. We'll have to keep some uh, funds and the resources for this. Then the reported profit and earnings. All projects change the income, expense, and asset report in the financial statements. If a shareholder is interested in statistics such as his EPS, the investment's impact on reported numbers should be part of the investment valuation. So we also need to see, especially when we are talking from a listed company, so what shareholders' expectations are. I mean, it can go back to dividends also, but apart from dividends, shareholders are also interested on the earning per share they are getting. What's the share price? So we need to be careful on the share price, how we can increase the share price, how we can maintain the share price, how we can have good reputation. Many times, just because of the reputation, just because of the rumors, sometimes the wrong rumors can also affect our share price. So basically, there are certain ratios that will be very important for us to maintain. The investors will look at different ratios. For example, as an investor, as shareholders, they'll be looking at EPS, they'll be looking at operating profit margin, they'll be looking at dividend payout ratio. But if it's a bank finance provider, they'll be looking at the gearing, they'll also look at the profit, they'll look at the asset turnover, right? They might look at different ratios. We'll see that when we are doing more on stakeholders. Then cash flow and earning volatility. Investors are concerned about the volatility of returns on their investment. The greater the volatility, the greater the risk and the greater the required return. So obviously, when our investors are taking risk, a higher risk, they'll accept a higher return. For example, if you just take a very basic example, a company which is well established, let's say they are doing business for decades. So if you buy shares of that company, usually they'll grow, but the growth rate will be very low. You might make a very small amount of profit in that because the risk was less and return is also less. But at the same time, you're investing in a company which is at the growth stage. So there is a high chance we can make more money, or there is also a high chance that we can lose more money. So higher the risk, higher the return. That's the normal situation. But sometimes we might have low risk and high returns, or high returns and low risk. Again, the type of company it is, if it's transparent, I mean, it has to be, especially when you're getting listed. So the types of shareholders will attract will be the same. If it is a company which is into growth stage and they are gone for listing, so usually the people who have bought their shares, they are looking for long term. They are working somewhere, they have their expenses taken care of, they have the money to pay their bills, right? But a company which is more established, they'll attract the shareholders maybe who are coming to retirement, or they are looking for a stable dividend income to pay their bills, right, for their personal expenses. And even if you go into another example, startups which are into just the introductory stage, so we have shareholders like venture capitalists, we call them VC. So they are taking very high amount of risk, but if they succeed, they'll make 100 times, 200 times their investment, even more. But they are taking the highest risk, and most of their bids will fail, will not go there. But whatever will succeed, they'll make, I mean, cover them up. So is their personal risk taking capacity, or maybe they can do as a group as well. Is it making sense for all of you? Because if we understand this clearly, when we go forward, things will become easier. Now, financing. The extent to which requirements can be funded internally, considerations of dividend policy and tax implications. Obviously, the first option is what? To use your own money, to use your retained earnings. Because here you don't need to take anybody's permission, you don't need to sign any covenant, you don't need to wait for some time, you can do it quickly, right? But we cannot just go and use the money we have. Firstly, we have to understand that retained earnings or profit is not equal to cash. If you are showing certain X, I mean, that's very basic finance. Sorry if it is just repeating. You know, we have studied that, right? If you have X amount as a profit, that's not equal to cash because we use different accounting standards. And retained earning is also not equal to cash. We might have certain amount of money, but that's not equal to retained earning or profit what we are showing in the financial statements. Also, the other consideration like dividend we have to see. Sometimes companies doesn't want to give a wrong signal in the dividend. Let's say a company is giving 30% of their profit as a dividend. So companies want to have a dividend uh, payment in the retained earnings for 3 years. They're like, even if the next year profit get disrupted, okay, I don't want to change the dividend policy. Maybe because their shareholders are coming or dependent on this money. They've got an idea, or their majority shareholders are, let's say, retired people. They need this money for survival or something like that. They don't want to disturb, so they'll have a lot of money just saved for the paying of the dividend. And also we need to look at the tax, we need to look at other policies. Obviously, why tax is important? Because companies want to go for debt, and debt is tax deductible. You're getting benefit of tax. If you're paying dividends to the shareholders, you'll pay from net profit. But if you're paying tax, it will go from the operating. You'll save some money by raising debt. If new externally provided finance is required, equity or debt, this may affect the level of gearing. So, what is gearing? Gearing is simple, the mix of the debt and equity. For example, how much is debt and how much is equity? Let's say 40% debt you have, 60% equity you have. So that becomes your gearing, mix of both. Now we need to decide how much equity we need to get in and how much debt. For example, if you go with debt, we'll get the tax benefit. Again, we cannot uh, take most of the money from debt because we might have to think about the future investment also. And if you take too much of debt also, companies will think it's very risky, because usually the investor want to think, okay, it should have more money from the equity than the debt, because they should have their more personal money than the debt they have taken from the outside. Because debt finance, the banks, they are not sharing the risk, they need their money, and usually it will be on the collateral, or they'll have very strict conditions with that. They don't care if you make profit or not, they just need their money. And sometimes just sustaining the interest rate will become a big mess for the companies. And obviously, if you have so much of debt and sometimes the companies are struggling to pay their interest rates and stuff, their share price can go down, their reputation can get affected to a very serious level. Then we have extent to which working capital should be financed by long term finance and short term. So, what are long term finance and short term? Again, short term less than a year. For example, credit card kind of thing. So, companies also have good relationship with the bank. They will get short term credit usually at almost no interest. They can use that for their working capital, or they need it for a very short term. In long term, more than a year. Okay. So, we can add maybe more things. This is just an basic consideration. Okay, can anyone of you tell me what other things we need to consider when we are financing? I'm sure there are many, but maybe just one of anything.
Our cash flow, the capacity that we have also to repay the debt.
Right. Good point. Cash flow they have discussed, but yeah, how much we can repay, because we need to see what are the future profit we are expecting. Okay, again the cash flow, the future cash flow. And
Also, if we're registered to be able, for example, to raise debt through bonds, because not everybody gets a listing. Even they can be like in the market, like as a listed company. It's a different way to raise finance. You have to get a different listing for bonds, for example. You have to get your credit ratings, and you have to go through a different path.
yes, so depending on our situation, it's not about how we are taking, but how the companies are ready to give us, because it's not only us. If they're not ready to give, then how we'll get it, right? uh, yes, Divesh, you want to add something?
Maybe, yeah, maybe gearing ratios like debt to equity ratios. We need to check also covenants if we have any restrictions for like interest and all before. If we are planning to raise in finance or money funds from bank, most probably we need to check gearing ratios. And if there is any covenant or if we have already some loans and all, we need to must check. So these things maybe need to take care of it if we are planning to take anything from bank.
Right. Taran is saying cost of financing, which includes interest rate penalties. Yeah. Then volatility while financing. Yes, Taran, that also makes sense. Manmeet, go ahead. Manmeet, you were adding something. Can you hear me?
Yes. I was saying that interest coverage ratio could be an important indicator as well if we are planning to take debt in order to finance our finance the investment. So, because it will show what how I'm able to cater my interest on the basis of beta which I am earning.
Okay.
Does it make sense?
Yeah, can you please repeat?
I just asked, does it make sense?
Can you please repeat? I didn't hear it clearly.
Okay, give me 1 second. I'll connect my headphones.
Okay.
Uh, so, uh,
Yes, Mega, go ahead.
So, from a shareholder point of view, if they want to purchase a share of a company or not, then they will see the history of the company, how they are growing, and how much dividend they are paying to the shareholder, and what are the share price of the company. Based on that, they make their decision of whether they have to purchase the share of the company or not. So this is the point of view of a shareholder. If like invest creditor, like they want creditor point of view, then they will analyze the obviously gearing ratio of the company, and they also see how they are managing their old loans, how they are means how they are paying their interest and repayment of their loan. So they will analyze the financial statement as well as the company's performance while repaying their loan and interest. So based on that, they will take a decision whether they have to give a loan to the company or not.
All right. Very good point. So basically, the credit history.
Yeah. So financial statement is one of the thing to analyze, and based on that, they make a decision whether they have to finance the a company or not, and the future perspectives of the company, what they are planning to, how to growth, what their future plan. Based on that also investor make their decisions.
Yes.
Makes sense. Manmeet, you are good to go.
Yes, I was talking about interest coverage ratio. If a company has taken debt or planning to take debt in order to finance their investment, the interest coverage ratio could be a great indicator to analyze whether they are able to take the debt or not, because uh, it just shows what is your current status of EBIT, and at what level you can, with that level of EBIT, at what time you can meet that interest cost.
Okay.
Yes. Does it make sense?
Yes, yes. So basically, you're saying like earning before interest and tax, how much you are getting, what's the amount? Basically, how much times you can pay your interest rates. Usually, banks want like
Yeah,
of 3 times, 4 times, like that.
exactly.
So basically, even especially if you're talking about debt, banks are almost risk averse. Excuse me. So definitely they will be looking at their point of view. If it is, let's say, just 1 time or 2 times, they might not be happy to give a loan to the organization. They'll say we want it like interest coverage should be like 3 times, 4 times. They'll have their minimum. Then only they'll extend the debt.
Yes. Can leasing and buying could be a part of financing, or it's the next step?
So yeah, that's a very interesting question, Manmeet. So what companies will do? They'll sell and lease back.
Hmm.
For example, companies who have their properties on prime location and they need to raise finance, so they will sell the property. However, they are not vacating it because the same property they are leasing back on a financing lease. So ultimately, you are having the hold of that. You're utilizing it, but you have to uh, pay a small money, as a lease, financing lease, until you get the property back on the company's name. However, at the start, you'll get a big chunk of finance which can be used for investment. So that is called sale and lease back. And there are companies who are doing it.
Got it.
Then optimal level of cash to hold. So guys, these are, this is an introduction kind of thing. We'll still go in details in the coming chapters. Okay, so just quickly, how much cash to hold? So there is a trade-off. There is no fixed answer. Again, it depends on you. So to hold too much cash versus too little cash. Too much cash means we are getting profit. Let's say 100 million and 50 million we have made dividend. So we have another 50 million. It's a medium company, right? So what they will do with that number? They want to just keep it with them, or they want to invest in a project, or they just want to keep it idle. So why they want to keep it idle? So many companies want to just keep it because they will utilize it. Especially, I was just giving the example of Google. They might have billions in just in the retained earnings. Why? Because they are holding it whenever they see any opportunity to acquire, and they acquire as an investment. When they see a startup coming up with the new technology, okay, they'll acquire it. So for acquisition, they need to have their free cash flow. They need to have their cash at bank. So they'll make immediate payment. They don't need to wait for months. If you're raising through equity or debt, it might take months. And sometimes you will not have that opportunity still available. So they'll have the money to just do it quickly. Or sometimes companies want to have this because they feel like it will be difficult for them to raise the finance, or maybe their gearing is not good. Their credit history is it's not credit history. Basically, credit rating is not good. So they can hold, but it's a tricky question. How much to hold? There is no one good answer, because if you hold too much also, uh, we have just discussed about the inflation. Because of inflation, the value of the money will go down. So there is an opportunity cost. So there will be a sweet spot how much we need to hold in the organization. We'll be coming back to this question again, and we'll discuss it once we know our financials specifically. Once we have our pre-scene out, we'll definitely come back and discuss this question, because many times this will depend on the industry also. Okay. Then flexibility. Holding cash means the entity can adjust its business plan. Yeah. Expectations of shareholders. An entity needs to consider whether its shareholders could make better use of the cash themselves. Sometimes what happen, companies holding a lot of money to invest in project or do any acquisition which will benefit them, but they are not finding any good one. So what they can decide is, okay, let's give it back to the shareholders. So sometimes they'll give a very big chunk of money back to the shareholders, which can be even more than 100% of that year's profit. So that is known as one-off dividend. However, they need to be very careful in communicating that this is one-off dividend. Why? Because shareholders might be expecting the same in the coming years. Or what companies can do usually, instead of giving this as one-off dividend, they'll give the cash back to shareholders, but they'll use a different strategy called share buyback. They'll buy back the shares. So in that, shareholders are getting money, but at the same time, they are uh, getting the shares back. So they are not diluting too much of the shares. They are controlling the share price. All right. Then sources of finance. Benefits of matching characteristics of investment and financing. Using long finance to fund both non-current and permanent current asset. Short term for financing to the mature. Sorry, will mature in a similar time to asset being disposed of. So basically, usually long-term financing is used for long-term funding. Short-term borrowings or short-term financing is used for short-term fund. However, some companies can be try to little bit clever. They might use small short-term funding, let's say for yearly funding for a 5-year project. They might not take a 5-year loan now, but they'll take small one-year loan each year, because they might have to pay lower interest rate. So that strategy they might also use. Again, so it depends on the situation. Now coming to the third important aspect is the dividends. What is dividends? The shareholders, basically the division of profits to the shareholders, to the owners of the business. How the shareholders earn? There are two areas. One is through dividends, and second is through increased share price. So when we are talking about the growth companies, usually companies who are in introduction and growth stage, they cannot pay dividends because they themselves need so much of money in investment to grow. So even the shareholders will understand that. However, in that situation, they want to see the growth in the share price. If the company is doing good, the share price should go up. But when the companies get matured, they want the share price to be stable and grow. Maybe not a very faster speed at a growth comparing to a growth level company. However, they need dividend. They need stable dividend. So dividends provide important returns to shareholders and can be seen as an indicator of success of the business. Shareholder returns comprise both increase in share price and cash informed. We just discussed. However, what we need to do, okay, the dividend decision has two elements: the amount to be paid out and the amount to be retained to support the growth of the entity. Again, when you're doing dividend, we need to be very careful about the investment, how much money we need for the investment. And obviously, when you're talking about investment, what financing options we have. Let's say during COVID times, companies cannot pay the dividends, right? Because they know financing becomes very difficult, and companies were almost having no revenue or very less revenue. Some companies doing okay, because they already have a good infrastructure in terms of IT, and people were working from home and they have got cash flows. For example, big fours, yeah, Deloitte and companies like that, they have got a higher cash flow, higher revenue during COVID time because companies were restructuring. But other companies actually struggle, other industry actually struggle. So this thing becomes important. There is also another important factor here. What company can do, instead of giving them dividend, they'll give them free share, and people can go and sell their shares. Why they can do that instead of giving dividend? Because in certain countries, now it depends, in UK will have a different rule, in Middle East will have a different rule. So the interest rates, the tax rates, if the tax rate is higher in dividend and less when you sell your shares, so they'll go and sell their shares. Or vice versa, if the dividends tax is less, they will be happy to get their money with in the form of dividends. So basically, what is the interlink? They've also gave something here, but I like to know from you, because we have directly discussed what they're mentioning here. Definitely we'll go through it again. But what is your understanding? Can any one of you or two of you just tell me your understanding? What is the interlinked? Or maybe if you can give an example. Hello? Anybody?
The question is how financing, investing, financing, and dividend
Yeah, how they
decision
are
are
interlinked.
interrelated.
I mean, you can see what's there on the screen. You can read also. I just need in your own words what you understood, because that was the topic for today.
Can I say something?
Sure, please go ahead.
Basically, that the financing strategy, the financial strategy that we'll choose will have an impact in all these three actually areas of like subcategories of financing, because each strategy will affect our investment decision, our financial decision, and our dividend decision. So basically, we should start with what is the course of the action that we're like, what is the, before going to the plan, basically, is what's the ultimate goal, and then cascade downwards to see the effects, like a scenario planning first before we take the ultimate decision. For example, if we want to undertake to acquire a company, we have to see, which is an investment decision basically, we have to assess, or let's say we want to grow, how will we grow? By acquisition, by organic growth, by merger, whatever the plan. So this is like falls more into the investment category. Then we have to see, based on that choice, how we're going to finance this. Do we have the cash? Do we have to grow? Do we have to get a loan? Are we going to go to a joint venture? Are we going to get bonds? Depending again on what we want to do, and our risks and our risk capacity and our finance capacity and everything. And that will have an effect, a knock-on effect on the dividends. Because if we, for example, decide to go to a financial strategy where we're going to have to pay, for example, debt, and we have like high interest rates and covenants and I don't know what, maybe we have to cut down on the dividends. Maybe though the share price will increase, and we know that the shareholders are looking both sides, but still it depends on what we can agree with them from the beginning. So actually, like, you make one choice and it affects everything.
Yeah,
Hello?
yeah, I'm listening.
This is how I understand how they're linked together.
Right. So basically, everything is coming down to this. And though this is about the finance specifically, but the other strategy like risk, uh, and what the actions we are choosing also coming down to this, because investment, finance, and dividends all are tightly interlinked. Anybody else?
Like the nature of investment decides the source of finance, and the source of finance can be could be internal or external. So if we go through internal source of finance, then it may be retained earning. So retained earning is based on the dividend policy, how much dividend we are paying. If we are giving paying more dividend, then we have a less retained earning, so we can't finance internally. So in this way, they are interlinked. Like a short term investment, like working capital and financing the activity of the business. Current business need sometimes it needs short term financing, so uh, we can finance it through short term loan, and we can also finance it through retained earning. If we are have huge cash in the business, then we can finance it internally also, and we can opt for external source of finance like loan, short term loan, bonds, like that. They are so they are interlinked in this way.
All right. Okay, so same thing they are mentioning here, and I'll definitely share this with some of you if you don't have this file. You can read it again. An investment decision to undertake a profitable project financed by raising new debt or equity finance may impact several important investors and lenders ratios, such as EPS, earning yield, and interest cover. Sometimes what happened, companies doing good, but the ratios might get affected. For example, if company started giving free shares instead of giving dividends, so what will happen? Ultimately, the wealth of the shareholders are same, but the EPS, the earning per share, or the share price will reduce. A lot of people will not understand that strategy, and they'll just think, oh, company share is going down. But that the same time, the number of shares are increasing. That aspect is being overlooked sometimes. Maybe they don't have the understanding, or they're not being educated about it. So companies need to think what people will understand, what are the basic ratios they will do. It also depends what are the financial education of the country where you are listed. There's so many factors we need to consider, because there is also a reputation factor. And remember, reputation is not very much controllable. You can control the brand, but not the reputation. We cannot control what people think about our company. Despite doing everything good, they might be like, oh, this company is just faking. Or even if things are bad, they might be thinking, okay, company is still good, they are ethical, we trust them. So we need to create that trust. You need to work on creating that trust. Financing requirements and cash available for payments of dividends are determined based on the overall consideration of the forecast future cash flows arising from investment decision, business strategy, forecast business, and economic variables. So basically, dividends, we have a separate chapter for dividends that will discuss in detail. However, companies cannot decide this year dividend based on this year profit, or this year dividend based on last year profit. They need to be thinking about the future. I was just giving an example just few minutes back. Companies want to sustain the dividends. They want to sustain, even if the profit is affected. They want to say, let's fix to a number or a percentage. That much will give every year, because we have a group of shareholders who are expecting certain returns every year, and that gives signals. Imagine a company which is giving a fixed amount for certain years. So what will happen? You'll get a lot of new shareholders who are in need of stable income. They'll come and put investment in this business rather than in a growth company, because they are looking for stable returns, and they are looking for uh, you know a certain return. Certain means you will get it. It will not affect their expenses. It will not affect their uh, plannings and all of those, their personal financial planning. Same thing you've written here. Change in dividend policy can have an immediate impact on some investor ratios, such as dividend cover, dividend yield. However, there may be other less obvious impact. For examples, reducing the level of dividend paid out 1 year could increase the amount of funds available for reinvestment. So there might well be an increased level of growth in profit, which would impact ratios such as EPS. Same thing. So these are just fundamentals. However, there are so many things that can affect financial strategy. One most important thing is whatever we talk about, the factor, and ultimately it's all human to human. We got it H to H. Whether it is B2B business, whether it is B2C, business to consumer, business to business, B2G, business to government, everything is about relationship, because at the end you're talking to a human, and that human will take decisions. It sounds strange, but most of the human decisions are actually emotional. When you talk about emotion, it's about the relationship. So ultimately, relationship matters. Maybe you are aware the same bank, maybe it's a government bank or a private bank, can give two similar companies two different interest rates. I think all of you are aware of this. So why? Why is that? That's because of the relationship. In fact, one of the key skill all of us need to have, especially if you want to grow in career or anywhere in life, is communication skill. It's not about the knowledge. Maybe you have seen some people have good knowledge when they're writing, or when you specifically talk to them or ask them about certain topic, but they are not able to communicate, or they are not able to show that in a corporate setup. Therefore they might struggle to grow in the career. So I would strongly recommend to, you know you all have good communication, but still invest in that. Your writing skill plus your communication skill, verbally, that will definitely help. So because of that only you can create a relationship. Now we have people who are just working as a negotiator for the company. In fact, there are certain people who can who has this as a job. Some of them are running as a business. For example, now our company need to raise debt. So if you go directly, let's say a bank is charging 9.5%, 9.5%. So if you go through them, you'll get the same deal on 9%. You can imagine even a half, or even if we get for 9.2, 9.3, and let's say we are raising billions. So how much it will affect? So they are just negotiator. And if it's a private bank, they might take commission from the bank as well. So they are earning from two ways. And we need them. So what are the extra things that can affect the financial strategy? The most important thing is the relationship. I think some of you also mentioned when we're talking about the resources. Like somebody was saying that we should get better deals. Then I ask how you'll get better deals? By maintaining relationship. Therefore, you have noticed now globally, companies, they have moved from transactional relationship to the CRM, customer relationship management approach. They'll ask your email, they'll take your numbers, they'll ask for your date of birth, they'll wish you on birthdays, because they have understood that cost of acquiring a customer is too high compared to cost of retaining a customer. So they are trying to invest in retaining the customer. When I say retaining a customer, even bank in certain way is a customer to us, because bank is giving us the money, and we need money to do the business. We need money to invest. Then only we can earn profit, right? Same thing with the shareholders. So basically, we have to sell our strategy to the stakeholders of the business. We need to be excited about that. We need to show, oh, that's the best thing. A bank might get so many applications, but they'll not accept. In fact, if you just go by the data, they'll reject most of them, right? Again, it depends on the geography. I'm just giving a basic idea. So what can change the scenario is the relationship with the investor, relationship with the banks, relationship with the government, relationship with your own employees, relationship with your competitors can also be helpful. In fact, it's important, because if there is a issue which is with the industry, so you don't need to do it alone. For example, both of you are investing X amount, so if you just do it separately, so it'll become 50% for you and 50% for them. then you can compete in the market, not a problem. Like I think recently Toyota and BMW was doing for something with the tires. Then airline industry, they are working together on the fuel. How they can uh, have a less pollution when they are uh, in the industry, right? Anyways, and whatever I'm saying, you are good to write that in your answers, because we need a practical answer. We don't need to put a bookish thing. Okay. So external influence on financial strategy, good investor relations, the most important part. The need to maintain good investor relations and provide a satisfactory return on investment, because sometimes what happen, we might not give them a good return. However, it's our responsibility to communicate properly. If you communicate properly, they'll understand. Sometimes we are doing good, but we are not communicating, there will be misunderstanding. Access to source of finance, limited access to source of finance either due to weak creditworthiness or lack of liquidity in the banking sector and capital markets. So what is our access? And obviously the economic situation we are having in, and if it's a global company, we can try to raise in different market as well. Gearing level, the main argument in favor of gearing is that introducing borrowings into capital structure. So basically we can save the tax with the debt, but how much we can do? Even government have certain regulation, it's called thin capitalization rules, like how much maximum tax benefit they can get in. Because what will happen, certain times companies want to get excess tax relief, so what they will do is they will take the debt from the parent company, then they'll say this is a debt and they'll save on the tax. But then the government will come in and say, you can only take the amount equal to what is in third parties allowed to means is ready to give you. If you are taking more than that, let's say the company wants to take $10 million, but the external party, the bank is ready to give only 5, so government will say you'll get tax benefit only on that 5 million, because rest 5 you got because it's your parent company, because they are favoring you, right? So things like this also come into place. We'll discuss that later on. Then debt covenants also matter. Certain time they'll put a covenant, the promise that you should not pay certain amount of dividend, you should not do this, not do that. So that will become very challenging. In fact, there are certain successful companies, they are having almost zero debt. They are not depend on the debt. They're okay to not get the tax relief. They're happy to pay a little bit extra, but they are saying they don't want an headache. They don't want a constant pressure from the banks. Don't do this, don't do that. Share us that information, because they want to do control. And sometimes it can be a big problem. For example, let's say you're acquiring a company, let's say it's a service based industry, and one of the reason you're acquiring is because of the human resource. You see that the top managers, the explicit knowledge they have. So if you're doing through bank, so bank will say, okay, I'm ready to do it, but you have to make sure in the target company these people should not leave the organization. So you have to do a contract with that employees. Then you have to make sure the uh, turnover is very less. So a lot of things they'll do. Staff turnover I'm talking about. So this thing can be a problem for the company, or they will reduce the risk capacity of the organization. Even the risk appetite of our organization is high, but they are locked. They are not in control completely because of the debt covenant. Then the regulatory bodies, the government can come in. So basically, the regulatory bodies, anything with the government is anywhere in the world is for the benefit of the society. That's their first aim. So what they want to promote the competition. So what happens when the competition is high? The prices will be in check. They will not charge whatever they feel like. Public will get the best possible facility or the product. Because of the competition, they will innovate, they'll invest, they'll grow, and there won't be a monopoly or duopoly. One or two companies will not dominate. So it depends again. For example, now from the UK perspective, we have talked from UK perspective, any company which has around 25%, that will be termed as a monopoly. So their market share should be less than 25%. Then the promotion of social and macroeconomic objectives. So the government wants that small and medium businesses should grow. If you see globally, small and medium enterprises are giving most of the employment. So government wants to promote them. They'll give them easy loan option, less interest rate, certain exemptions on tax, sometimes grants, all of those. Then economic major economic influence such as interest rate, GDP rate, exchange rate, so many things. What is happening in economy will also affect the business. Like we just talk about Bangladesh, what's happening there. So definitely the international business or even the local business will be in a very tricky situation because things are uncertain now. They don't know what will happen tomorrow. So if they were about to do certain investment, most of them would have been on hold for now. What else can be affected? Government influence. In certain countries, the government influence is very high. Regional policy. What is the policy for the government? What is the policy for the local business? What is the policy for the international business? And what is the employment rate there? For example, if the unemployment rate is higher, then the government will be okay because they want to give jobs to the people. Otherwise, if the unemployment is not an issue, they'll be very strict. Taxation policies, legislation. So there are so many things we can add, maybe 4 or 5 more as well. But it's okay, just about the understand. Then the most important part is the tax implication. How much tax they'll pay. Companies can find a loophole and they'll want to pay the tax in the countries, for example, where the tax is lower. Let's say now there's a 25% tax in the US. So Google is not paying 25% tax here, or they are paying considerably less, but they want to pay in Switzerland and other countries, or they want to set up in different part of the states or different part of the world where the tax is very low, or even they want to go in tax haven. What is tax haven? Where there is almost zero tax. So this is how uh, companies can do, but there can be a reputational risk, and oftentimes this can be looked as unethical, because ultimately if you're earning money from one country and you have to pay back to the government, because the government will eventually spend that money back to the people. That means you're taking away from your own clients, your own customers, which you talk about in your values, that you respect them and you want to make life better for them, things like that. Same thing works in international tax implications. Okay, so the last part of the section is the lender assessment of creditworthiness. Ultimately, they will see what is the credit rating, how the company have been doing in the past. What are some basic factors? For example, they'll definitely look at what is the purpose of a loan. For example, we discuss about acquisition, the amount we need, the duration we need, how many years, what is our expected cash flow, when we are planning to repay it, what is our creditworthiness, how much we have already taken loan with, is it through the same bank, is it through the other bank, right? What is a business prospect, what security you are providing. Obviously if it is collateral, then it is a little bit easier. Otherwise it can be maybe risky, and risky means bank will charge higher interest rate. What is our credit rating? I was coming to that. It's most important. And other borrowings and covenant. So credit rating is very important. Usually we follow these two companies, Moody's and S&P, Standard and Poor's. They'll also do all of this for the bank, and they'll give the reference. For example, AAA is investment, lowest risk. Then we have AA. So slowly as we go down A, B, C, the ratings will reduce. You don't need to remember this. Usually this is tested if some of you is writing individual F3 paper. However, this is for understanding. We'll not know from our pre-scene that what rating we have, but usually it will be good unless they have mentioned anything. So we can say if it's not AAA, it may be AA or a single A, like that. So based on this also, our financing option will get affected. Yeah. So that's it from this chapter. Any questions, please? Yes, Vishal.
So maybe just one last comment on this, Misbah. So when we define the, so we will not get to know the rating. That's obvious, but then we can look at the balance sheet to understand how much debt the currently company currently holds, and that also defines the credit rating, right? Basically, the debt coverage ratio can also help us to gauge whether this company is a double A or triple A.
Yes, definitely. We don't know exactly, however, the points. For example, what we discussed, like what are the forecasts we might know from the pre-scene, the strength and trend in the industry will know, risk will know, right? Quality of management team will know from the pre-scene. That attitude towards risk will know, understand a little bit. The position, the ratios, what is the group of companies, what parent support they have. From this, we'll get a basic idea. Okay. Vishal, does it make sense?
Absolutely, absolutely. I agree with these points. Sorry, I was on mute speaking.
Thank you. Anybody else has any doubt on this particular chapter? So I request you guys to go through it again, and please go through the next one also, chapter 4. We'll do this one in tomorrow's session. We'll be starting at the same time. So that is equity finance. Now we'll go in detail. We have equity, then we'll have debt, like that. So tomorrow we'll be discussing on equity and debt. These are the topics. Just one second. Yeah. So we'll discuss on equity and debt tomorrow. So basically, we have done an introduction on that equity and debt. Now we'll go in detail on each of them. What are the advantage and disadvantage of bonds? What are the advantage and disadvantage of taking a bank loan or working with a financial institution? Then type of loan. We have convertible debt also. We have normal debt. All of those we'll discuss. So it's good if you just have a quick read before we start tomorrow. Okay, and please come with the questions as well. All right.
Yeah, sounds good.
Thank you. Thank you for joining. Have a good evening.
Thank you.